Sometimes it's better to know nothing at all than to just know half of the truth. And the problem is that when you're following currently a lot of YouTubers that discuss investing, that you're only getting half of the truth. So this is the common narrative. Common narrative is that you should be taking parts of your income and you should take that money, put this into a low-cost index ETF, and then save over the years and over the decades. And once you want to retire, you've got a very nice nest egg that you can then use for spending. So that's the common narrative. But here's the problem. The problem is how things turn out practically. So let's say you are super motivated, right? Let's say you're earning a lot of money, you're working really, really hard, you're saving a lot, and you can achieve, say, a 30% savings rate after taxes. So you stash away 30% of your income. And let's say you're new to all of this game, right? You started doing this, and let's say you're saving for 3 years. Okay, so 33% of savings rate over 3 years means that after 3 years, you've saved up 1 year of your income. So that's nice, right? That's quite a nice nest egg that makes you feel quite safe. Let's say on top of that, you are also very lucky. Let's say the S&P 500 actually doubled within those 3 years. Doesn't happen very often, but sometimes it can. So then after those 3 years, you suddenly have 2 years of income saved up in those index ETFs. So it looks like what those YouTubers said about investing plays out perfectly. You're very happy. You're simply just continuing what you're doing at this moment. The problem is you shouldn't be continuing what you have been doing. You should start doing other things. Because here's what happens. When the index goes up and it doubles, at some point some euphoria might kick in, and then volatility increases, and then suddenly the S&P 500 crashes by, say, 50%. That's also possible, right? So there's volatility on both sides. Suddenly, your net worth goes from 2 years saved up to only 1 year saved up. That can be very, very nerve-wracking, right? So before you felt very safe, you felt it was the right thing to do to save up all of that money. Now you've suddenly lost an entire year worth of work because of that crash. Now, what happens when you live through this the first time? A lot of people will panic. Right? A lot of people will consider selling, and they will in the end indeed sell. So that's the problem, right? Those finance YouTubers will say, yeah, just continue holding through the crash. But if you suddenly experience that volatility, if you suddenly experience an entire year worth of labor getting flushed down the toilet, then things look a bit differently in practice. So what should actually be the right thing to do here? The right thing to do should not be to just save in the S&P 500 ETF and keep this running forever. Because this is just an example after 3 years, right? It's an extreme example because we rallied a lot and then we crashed a lot, but it's a possible example. Simply extrapolate this out for more years, right? Let's say you're saving up now for 10 years and then you get that volatility, then the whole story becomes even more nerve-wracking. So really, what's way more important than to simply just set and forget, to simply just buy and hold, and to simply just save a fraction of your income and do this over many, many years, a change in strategy has to happen. And I think that change should be twofold. The first thing that should happen is that you need to diversify across asset classes. So you don't just buy different stocks, you don't just buy different stocks in different countries, etc. It makes sense to buy instead something that doesn't move with the stock market. So it might make sense to take a lot of that stock portfolio and use this maybe for the down payment on a house. Or it might make sense to take some of that stock portfolio and move this into precious metals, or move this into Bitcoin. Move this into something that historically didn't move in the same directions as the stock market. You might also consider long-term government bonds, right? Right now, the interest rates are very high. So when interest rates go down, then long-term government bonds go up. That's another way to diversify. But you have to buy something that doesn't move in the same way in those ups and downs. This helps in two ways. It helps in the one way that you don't fluctuate that much in your wealth, but it also helps you to potentially take advantage of some of those crashes. Right? Let's say half of your portfolio is the stock ETF, the other half is, say, in long-term government bonds. Now the stocks suddenly crash. Your long-term government bonds do not crash because they go up whenever interest rates go down. What happens then? Then you can shift some of those long-term government bond funds into the cheap stocks and take advantage of the dip.
This video is sponsored by the premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the premium membership. Feel free to check it out.
So you're not just buying the dip with your income, you're actually buying the dip with wealth that did not go down. So on the one hand, you reduce the overall volatility, but on the other hand, you also take advantage of dips. So suddenly, when you do see a crash in the market, you're not necessarily worried about it, right? You're not worried about this 1 year worth of savings going down the drain. You actually feel okay because it's only half a year of savings going down the drain, and at the same time, you still preserve your capital, potentially capital in other asset classes even goes up, and then you can take some, at least, of that capital, buy the dip with it, and in the end, you will come out as a winner, right? Because in the end, you bought cheaply, and you will have even more money after that crash. So you take advantage of crashes. You are, of course, short-term burnt with a crash to a degree, but in the end, you will come out as a winner because you buy very low. That's something a lot of investment YouTube channels don't tell you. They just tell you buy over the long term, the low-cost index fund, and never look at it. But in practice, you are going to look at this, right? When it fluctuates that much, psychology does play a role. So that's the first thing that needs to be done, right? The first thing is to diversify once you clear a certain threshold. And I'd say that's around the 2-year mark, 2 to 3 year mark of income saved up. That's when diversification becomes really key, because then when it crashes, you can't take that much advantage of the crash if you're only buying with your regular income. So having 2 to 3 years of income saved up, I believe, is a threshold where diversification is really key. Now, there's another effect that happens at around that threshold, and that's making sure that you actually take advantage of your capital now. If you've got only, say, 2 or 3 months of your income saved up, then growing those 2 or 3 months of income doesn't really move the needle that much, right? Your savings rate will really increase your wealth a lot, so your regular income will really matter, but getting an edge in the market, getting a high return on your investment doesn't matter that much. So really, at those kind of levels, it still makes sense to focus selling your time, potentially selling even more of your time, right? Maybe getting another side hustle, etc. So it's really time selling that's the best leverage. But once you hit, say, the 3 years of income saved up, then it's not necessarily anymore selling time. Because think about it. Let's say you save a third of your income and you do this for a year, right? You earn 0.3 years of income and you've already got 3 years saved up. That means that all of the savings that you're doing only contributes to your wealth growth by 10% per annum, right? 0.3 years saved versus 3 years you already own. So only 10% per annum. That's roughly how much you can expect just buying the S&P 500 low-cost index ETF. So you make the same kind of money buying the S&P 500 ETF versus all of the savings you do with your regular cash flow, with very aggressive savings even. So what that means is, if you can find a way to outperform the market, maybe by buying assets that are currently rising a lot, that have a lot of momentum, and exiting them early, maybe by buying something that's a bit more risk on, let's say Bitcoin versus the S&P 500, and buying Bitcoin when it crashed, right? Not when it went up already quite a lot. Putting in a bit more time in trying to beat this very standard metric of the S&P 500 might pay off as much as saving all of that money. So if you're actually able, with enough studying, to turn your 10% per annum into 20% per annum, maybe by levering up a property, right? Maybe by putting that down payment down and then getting a lot of ROI on your equity, or maybe by buying Bitcoin when it's low, or whatever it is, right? If you find a somewhat semi-safe way to increase your return on your 3 years saved up, then that activity is worth as much as all of the savings that you're doing. Isn't that fascinating? You could, in theory, learn about all of those kinds of things, save the exact same amount of money, and stop putting any money away from your actual job. So you actually have expendable income that's now 50% higher than before, right? Before you spent 66% of your income, then you could spend all of your income if you're able to increase your return on your investments from 10% to 20%. This is what kind of a leverage we're talking about. And that's the kind of complex theoretical thoughts that most people aren't going to tell you about. Most people tell you just ride out the waves, forget about the S&P 500, just save regularly. And yes, at the beginning, for the first 3, 4, 5 years, this makes a lot of sense because you do want to build your Nasdaq, because you do want to sell a lot of your time and take those savings into building up your portfolio. But once you hit a certain threshold with that, once you hit the 2 to 3 year mark, then it makes sense to put a lot of your brain power, not anymore into selling time, but instead into finding out how to grow what you already have. There's way more leverage in that now because now you've got capital. Be sure that you don't drop 50% of your wealth just because the S&P 500 drops by 50%. Be sure to be able to buy that bottom very heavily once we do see a drop because you own other things as well. Be sure to buy assets that potentially outperform the S&P 500. Maybe buy tech stocks that you have a strong conviction in. Maybe buy a property with a lot of leverage. Maybe buy Bitcoin when it's cheap. There's many ways to roam. But I do believe it makes sense to put adequate brain power into multiplying your investments once you have enough capital. You don't have much leverage once you're poor, but you also do not want to miss the boat that once you do have the capital, that you grow this. This is also a mistake that a lot of people do, right? They learn about those things way too late. When they've got maybe already 5 to 10 years saved up, then it's the first time they think about investing. Then they haven't really learned adequately, and then they might lose a lot of money even. If you enjoy these kind of discussions, then feel free to give this a like because it helps the channel grow. Feel free to also share this with others. And of course, feel free to also subscribe. There's also a Telegram channel. The link is down below. You can join there. Looking forward to chatting with you in Telegram. See you over there. Cheers.